Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
A little bit of background on me. I wrote a book called One Shot, One Kill Trading, published by McGraw-Hill in 2004 and then republished by myself in 2007. Great experience for me as far as writing that book and putting together my thoughts and ideas. The president of One Shot, One Kill Trading. I put on a few workshops and whatnot, but really most of what I spend my time on nowadays is really trading, and then working with managers out there and working with other people out there in terms of developing their strategies so that if they want to grow collectively. I wrote a spread paper for another exchange on spread trading equity index futures, and I had the chance to go and present to a number of proprietary trading firms and market making shops in both Chicago and New York. So really my focus is on more works with everything from retail to the top level institution in terms of strategy collaboration, asset aggregation, and business development. So I've kind of seen it all and worked or seen most of it and worked with most of it. So I'm just really passionate about the markets and passionate about what both the structural and the strategic component of the markets. Very quick background again, guys, just to hit this up. We're going to talk about calls, puts. If you hear me mention strike price, implied volatility, the expiration months, in terms of the intrinsic value, and then composed of four Greeks. So when I talk about calls, I'm really, a call basically gives someone the right but not the obligation to purchase something at a specified price by a given date. That obligation acts much like insurance does. Conversely, with a put, we're dealing with a vehicle that gives a person the right but not the obligation to sell something by a specified date. So if you're buying a call that's intuitively a very bullish position, if you're buying a put, that's intuitively a very bearish position collectively. If you're selling a call, that's much more of it is a bearish play, and if you're selling a put, that's more of a bearish play. You combine those two together, and all the machinations that come from that is what we'll delve into as this class goes on. When I talk about the strike price, I'm referring to the price from which those calls and puts become valid or become in the money. When I mention implied volatility, really by implied volatility, we're talking about the perception of the future range of that market. And so that differs from historical volatility, where that was the realized range of that market over a specified time period. So I talked about earlier that implied volatility on the S&P 1 month are very different than implied volatility on the S&P for 3 months out or 6 months out. And all those go into, all those play a factor. The expiration month, kind of like I talked about in terms of the S&P, 1 month, 3 months, 6 months. Obviously, the longer the time on an option, at least the time component of the option becomes worth more. Depending on how volatility is priced, that's a whole other story. And so let me give you an example that we'll see these vol curves set up very interestingly at times. And if you go back to October of 2008, November of 2008, we saw these very these sharp ratios between the implied vols of the front month contracts and the back month contracts. We saw the VIX trading with implieds of 55, 56, 57 for 30-day at the money calls. Then we saw 60-day or 90-day at the money calls were trading at 49, 48, 47 or 52. So there's quite a bit of disparity between the implied vols. Now actually we have the converse. We have the opposite effect. We're looking at implied volatilities on the S&P right now, which sit at 20, 21, and if you go back 60, 90 days from now, we're seeing it 24, 25. So that process and that relationship between those implied volatilities is very, very fluid, to say the least. So with that said, intrinsic value, obviously, what would the option be worth if it expired today? That's the intrinsic value behind the option. You also hear people talk about extrinsic value, intrinsic value, obviously the opposite of extrinsic value, intrinsic value. And then options are composed of four Greeks. There's many more than that, but I'm going to focus on four today is what you'll hear me reference: the delta, the gamma, the theta, and the vega. Looking in terms of what we're talking about on implied vols in terms of the perception of the future standard deviation, I want to spend a little bit of time in terms of just kind of discussing that pricing model behind a Japanese yen contract. I use a couple different platforms to trade on. CQG is one that helps me in terms of the underlying futures that I trade. If you can use the ISE options, and then you can either use the futures to hedge out, or you can use the spot like I talked about. Here's some of the analytics from CQG. I also trade on Bloomberg, and also use TT as well, Trading Technologies. There's other options packages out there that you can do stuff on. ORC is a very robust software application. If you want to do some really high-end options analytics, you can do on Option City, and there's more that goes on with that. But even RTS, if you want to develop some other systems as well. If you have any questions about options software, by all means send me, because I can literally do an hour just on the benefits and drawbacks of each of those respective packages that I just went over and mentioned, as I've traded on many of them. So, but just taking a real quick look here at this Japanese yen. Let me go ahead and highlight my look at the cursor here, or the pointer button. Bang. All right. We see here this is the Japanese yen futures contract. Look in terms of like where the volatility and how that's priced in here. About 12.53 for these front month guys here that as of last Friday expired. They expired this Friday, so they have about 3 days left to expire. I did this. Created a slide last Thursday night, right before I went out for New Year's Eve in Vegas, and you can just see here that with implied vol being what it's at, what does the Vega mean? I just mentioned the delta, gamma, theta, and Vega. So what happens if the market falls off by 1%? And so you get a sense of that if the at-the-money calls are pretty close to their price at 63, all right, and we get a 1% drop in volatility, you're going to more or less see about 6 or 7 ticks fall off of that call right there, and drop down to, let's say, 57 ticks at that point in time. So it gives you a real-world example in terms of what these analytics can do, of letting you know approximately how implied vol, if it changes, will impact the underlying pricing. Now you can get into VAMA and VANA, which measure the rate of change from volatility and how that impacts that, but again, it's a little bit beyond today's presentation. Again, looking over the Vega here, I just talked about the 112.53 spot in terms of the theoretical P&L. If we were to get a 1% shift, and we saw earlier, or a little more than that, 12.53 was the implied vol. What happens if volatility fell to 10.5 with 5 days of expiration left? Well, all of a sudden, we would, we'd take this much of a P&L hit at that point in time, whereas the option, could be currently worth $112. Well, now all of a sudden it's down $500, and of course this being the bottom line here is the max loss you can take. So this was approximately the current value with 8 days left. This would be the value with 5 days left, and the VIX sitting at 1080, and the price still being the same on the Japanese yen. So again, it just gives you a little bit of an example there of how the pricing behind the Vega works. Since we're going to spend a fair amount of time today talking about implied vol and what that means to balancing across multiple asset classes. Just looking over the realized volatility of major currency pairs and kind of what that's done. When I talk about ranges up near 300 pips a day, here's a look at the USD JPY. All right, some really nice trading for those of us that are very long premium or gamma friendly traders, which I would definitely fall more into that category than the guy that likes to come in and be short vol per se. But there's clearly time and places for everything, as I'll break down my viewpoint and portfolio coming here in the coming slides. But we get a chance here just to see that the average range across these markets, and I set this at a 22-day range that represents one full trading month with 22 trading days. So as far as this average true range goes, this is based on a 22-day average, and that's how I set these in place. So it's not hard to see that we went from obviously a very tumultuous time in last October, November, a little bit of an uptick near the lows here in terms of realized vol. ATR and realized vol basically the same thing, the average true range versus the realized volatility, and then we begin to a bit more of a grind. Then in December, unlike what the equity markets did, if you go back to December 3rd, it was an event I was waiting for some time. We had non-farm payrolls come out with a nice little upside surprise, and the dollar obviously was undergoing a great deal of pressure. And it was this up until that point in time, and it was with this number actually that the dollar began to mount a much more meaningful balance against the other currencies.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.